Hello everyone, welcome to lecture 2 of redemption of preference shares. Before we proceed with this lecture, all of you are required to revise with the 4 conditions of redemption and the accounting entries what we have done. Okay, before you watch this lecture, you must have written it in the notebook in the summary in the beginning. So go through those 4 conditions as well as go through the journal entries of 6 entries which I made you write in the notebook for redemption. Look at question number 1, be attentive. 3 questions will be taking up in this lecture. Question 1, 2 and 13. Calculate the proceeds of fresh issue of 20,000 shares of rupees 10 each made for the purpose of redemption. Clearly given that company has made fresh issue of 20,000 shares of rupees 10 each made for the purpose of redemption of 4,000 shares, means these are the preference shares which are to be redeemed. Fresh issue of which 20,000 shares is made equity or preference is not mentioned, so we can assume it's equity shares, but redemption of equity shares is never possible as per the Companies Act. So this redemption of 4,000 preference shares are preference shares only of rupees 100 each, redeemable at a premium of 5%. So 4,000 preference shares of 100 each means 4,000 into 100, 4 lakhs. And then 5% premium of 100 is 5 rupees. So 4,000 into 5, 20,000. What we have to repay to the preference shareholders is 4 lakhs plus 20,000, 4 lakh, 20,000. But there is an important point which I will discuss when we solve this practical question. So keep this in mind. Towards the face value, what we have to pay is 4,000 into 100, 4 lakhs. Okay, towards the face value, what we have to pay is 4,000 into 100, 4 lakhs. And towards the premium, what we have to pay is 4,000 into 5 rupees. 100's 5% premium is 5. 20,000 is what we have to pay towards the premium. Okay, this is how the redemption is to be done. Now this fresh issue of 20,000 shares, they say if fresh issue is made at par situation 1 and at 10% premium situation 2. So we have to find the proceeds of fresh issue of shares. 20,000 maybe equity shares of 10 each are issued in the public. They are asking you, if this 20,000 shares are issued at par, then what are the proceeds? If this 20,000 shares of 10 each are issued at premium, then what are the proceeds? This is what they are asking you. And then they also ask, also calculate the minimum transfer to capital redemption reserve. We have studied condition 2 of section 55 that there are 2 sources of redemption of preference shares. One is out of the profits of the company, which we studied in condition 3. If you redeem out of the profits, then they are to be transferred to capital redemption reserve. Then in condition 2, we studied second point. Second source of redemption is proceeds of fresh issue of shares. Here 4 lakhs of preference shares are to be redeemed, but only 20,000 shares of 10 each are issued in public. So you can say we are going to use both the resources. Okay, there are 2 sources as per condition 2, profits and proceeds of fresh issue. Some amount for redemption we will use from proceeds of fresh issue and some amount we will use from profits, and then profits would be transferred to capital redemption reserve. So they are asking you what is that minimum amount to be transferred to capital redemption reserve. Okay, I read the question once again, understand it properly. Calculate the proceeds of fresh issue of 20,000 shares of 10 each. Okay, and directly see this. If fresh issue is made at par or at premium, then what are the proceeds of fresh issue? Then further, for the purpose of redemption of 4,000 shares of 100 each, redeemable at a premium of 5%. So 4,000 into 100, 4 lakhs we have to repay towards the face value, and 100's 5% premium is 5 rupees. So 4,000 into 5, 20,000 we have to pay towards the premium. So all of you make these columns in your notebook. Situation, there are 2 situations, fresh issue at par and fresh issue at premium as we have seen here. Okay, and then you make the column redemption of preference shares. Mark this important, nominal value. Nominal value means face value. Okay, why I will tell you, only nominal value we are taking. Proceeds of fresh issue of shares, an amount to be transferred from profits to capital redemption reserve. These are the two things asked in the question. Okay, first question asked this, calculate the proceeds of fresh issue of shares. Last question asked this, calculate the minimum transfer to capital redemption reserve. So amount to be transferred from profits to capital redemption reserve. Pause the video and make these columns. I hope all of you are done with the columns. Now be attentive. Why we take only nominal value, understand this. When we talk about redemption of preference shares, then preference share capital includes only face value, because premium goes to a separate account, that is premium on redemption. What is the liability of the company as the share capital is only the face value, that is the nominal value. So whenever we apply this second and third condition of section 55, which second condition? Sources of redemption, profits and proceeds of fresh issue of shares. And third condition, transfer of profits to capital redemption reserve. We will always consider only redemption of preference shares nominal value. Throughout the chapter, remember this. When we talk about condition 2 and 3, what I made you write in the notebook for section 55, we will consider only nominal value. Okay. Condition 4 exclusively deals with premium. There is a separate condition for premium, that premium on redemption of preference shares has to be provided from profits of the company and security premium account. There is altogether a different condition. So condition 2 and 3 is we are what focusing in this question on, and that condition 2 and 3 will consider only nominal value, face value of redemption of preference shares. So let us solve this question. What is the face value of redemption of preference shares? As we discussed, 4,000 into 100. That is 4 lakhs. All of you write down this in your notebook. 4,000 into 100, 4 lakhs. Now, what are the proceeds of fresh issue of shares? The shares here, it is given are issued at par. So, 20,000 shares are issued at par. Face value is 10 rupees. Means what are the proceeds of fresh issue of shares? 20,000 into 10. That is 2 lakhs. Now, out of 4 lakhs, 2 lakhs will be utilized from proceeds of fresh issue of shares. So remaining 2 lakhs we will have to take from the profits of the company and transfer to capital redemption reserve. Okay. Out of 4 lakhs, the face value of preference shares what we have to pay. Out of 4 lakhs, the face value of preference shares what we have to pay, we will use 2 lakhs from proceeds of fresh issue of shares. So remaining 2 lakhs we will take from profits and transfer to capital redemption reserve. Okay, we discussed in the first lecture that balance of share capital is to be maintained. Okay, if preference share capital is decreasing by 4 lakhs, then by issuing the shares of 2 lakh, it will increase by 2 lakh half the way. And when we transfer profits to capital redemption reserve will be used in issue of bonus shares in future. So again, share capital will increase by 2 lakhs in future. So 4 lakhs of total share capital will be maintained intact, and the risk of outsiders and creditors will not increase. So once again, 4,000 into 100. 4 lakhs is the nominal value. Whenever you apply condition 2 and 3, remember, take only nominal value of the shares. So 4 lakhs into 100, 4,000 into 100, 4 lakhs is the preference shares to be redeemed. Out of that, what proceeds will be available from fresh issue of shares? 20,000 into 10, 2 lakhs. And out of 4 lakhs, 2 lakhs from fresh issue. So remaining 2 lakhs we will transfer from profits to capital redemption reserve, so that the total capital remains intact. Now, if fresh issue is made at premium, first of all, nominal value of preference shares is going to remain the same. Now, a question I'll ask you over here. What will we take in the proceeds of fresh issue of shares if they are issued at premium? Okay, premium of 10% on 10 will be 1 rupee. So we can say premium is 11 rupees is the issue price. I repeat, 10 rupees, 10% premium 1 rupee means issue price is 11 rupees. So I ask you a question. What will we take in proceeds of fresh issue of shares? 20,000 into 10 or 20,000 into 11? Think about it. 20,000 into 10 or 20,000 into 11? 20,000 into 11. Wrong! 20,000 into 11 will not be taken. This is what is important in this chapter. Here also we will take 20,000 into 10. That is 2 lakhs. Now understand it why. If you issue the shares at premium, what is the journal entry? Bank to share application to share capital to security premium. Is your share capital increasing by 2 lakh or 2 lakh 20,000? Our purpose is share capital should remain intact. So even if you issue the equity shares at premium, share capital will increase by 2 lakhs only. 20,000 will go to a separate account, security premium account. So keep this in mind. When we consider condition 2 and 3, even in preference shares, you'll take only nominal value. Even in equity shares, you'll take only nominal value. Okay. Proceeds of fresh issue of shares. This you can write as a note. That proceeds of fresh issue of shares. Okay. Proceeds of fresh issue of shares does not include premium. Proceeds of fresh issue of shares does not include premium. It will include only face value. Okay, logic. Purpose is share capital should be maintained intact. So even if equity shares are issued at premium, only face value of 10 rupees, 20,000 into 10, 2 lakhs will go to share capital, and 1 rupee of premium will be going to a separate account, security premium account, which will be shown in reserves and surplus. So proceeds of fresh issue of shares will take only face value. So here also your answer remains same, 4 lakhs minus. Here also your answer remains same, 4 lakhs minus 2 lakhs. What amount will be transferred from profits to capital redemption reserve? 2 lakhs. So whether you issue the shares at par or at premium, your answer will remain same. Okay, whether you issue your shares at par or at premium, your answer will remain same. Is every one of you clear with this? Okay, so this will help us in the whole chapter. Keep this in mind. Condition 2 and 3 of section 55 will not include any premium for redemption of preference shares, and proceeds of fresh issue of shares also, even if they are issued at premium, for the purpose of condition 2 and 3, we will not include premium in the same. Premium is dealt with in separate condition, that is condition number 4. Right? All of you can revise with the conditions before we take up with the next question. Yes, now all of you look at question number 2. Be attentive. Following is the financial position of X Limited on the date of redemption of preference shares. Amount in rupees. Equity share capital of rupees 10 each, 8 lakhs. Existing equity shares have face value of 10 rupees. That will be relevant. Preference share capital of rupees 100 each. Now underline this, partly paid up. What is condition 1 of redemption of preference shares, section 55? Only fully paid up preference shares can be redeemed. So these partly paid up preference shares, all of you write down, cannot be redeemed. Okay, partly paid up preference shares cannot be redeemed. And here we don't have any information also. 100 is partly paid up means how much is paid up, 70, 80, 90, that also we don't know. But these are partly paid up preference shares, so they cannot be redeemed. Look at the next one. Preference share capital rupees 100 each. Now here it is given fully paid up. So fully paid up preference shares can be redeemed. Means in this question what we are going to redeem is this 4 lakhs divided by 100, 4,000 preference shares. These are what are going to be redeemed. These partly paid up preference shares cannot be redeemed. Only fully paid up preference shares can be redeemed. So 4 lakhs divided by 100, 4,000 preference shares is what we are going to redeem in this question. Capital redemption reserve cannot be used, okay, because which are the profits which can be used as a source for redemption of preference shares which are otherwise available for dividend. Capital redemption reserve is not available for dividend, so that profit cannot be used. In fact, we transfer the profits to capital redemption reserve, but capital redemption reserve existing in the books cannot be used for redemption of preference shares. Reason: it is not available for distribution as dividend. Security premium can be used but only to write off premium on redemption. Okay, security premium can be used only to write off premium on redemption. Profit and loss account can be used for both. Both means what? It can be used for redemption of preference shares towards the face value, as well as it can be used to write off premium. Okay, condition 2. The preference shares can be redeemed out of profits of the company which are otherwise available for dividend. P&L account is available for dividend. Condition number 4. Premium on redemption shall be provided out of security premium account as well as profits of the business. So capital redemption reserve cannot be used neither for redemption of preference shares nor for premium. Security premium can be used only to write off premium on redemption, but this profit and loss account can be used for redemption of preference shares as well as to write off the premium on redemption. Current liabilities, fixed assets, non-current assets, investments, current assets, bank and other current assets. These are normal things. We are mainly concerned with share capital and reserves only in this chapter. To redeem the preference shares, following resolution is passed. First, preference shares are to be redeemed at a premium of 20%. Okay, preference shares are going to be redeemed at a premium. Investments are to be sold at a loss of 5%. First condition I told you, if you redeem the preference shares out of profits, and then accounting entries also I made you write. I told you that if company redeems the preference shares out of the profits, then company may not be having that much cash in the business. So company may have to sell the assets to make the availability of funds for making the payment to preference shareholders. So this would be our journal entry number 1. I made you write in the notebook. First entry will be to sell the assets. So for selling the assets, investments are sold at 5% loss. Here you all can see investments are 4 lakhs. They are sold at 5% loss. Market value is 4,75,000. That is not to be considered. 4 lakhs are sold at 5% loss means we have sold for 3,80,000. 4 lakhs 5% loss is 20,000 loss. Okay, 4 lakhs 5%, 20,000 is loss means we have sold for 3,80,000. So that first entry will come. Bank account debit 3,80,000. Bank is the receiver, debit the receiver. Profit and loss account debit with the loss of 20,000. Debit all expenses and losses. Investment goes out, credit what goes out to investment account 4 lakhs. 10,000 equity shares of 10 each are issued at par for the purpose of redemption of preference shares. So 10,000 into 10, share capital will increase by 1 lakh rupees. For the remaining amount, we will transfer the profits to capital redemption reserve so that the total capital remains intact. So we are going to use both the resources in this question. Profits also and equity shares also. Equity shares already given 10,000 are issued. So whatever the deficit remains to balance the share capital, that we will transfer from profits to capital redemption reserve. Okay. You are required to pass necessary journal entries to record the above transactions, assuming that all necessary formalities are complied. Now, this is the fixed set of workings we will be making in all the questions. Once we solve 2 to 3 questions, you will become confident with that. So all of you make these workings along with me. First, only one working is there in fact. So even if you don't number, it's fine. But working note 1. First, you write down number of preference shares to be redeemed. All of you must be writing it. number of preference shares to be redeemed. Now, we all can see here that this partly paid preference shares cannot be redeemed. What can be redeemed is this 4 lakh of preference share capital, and 4 lakhs divided by 100, there are 4,000 preference shares which are to be redeemed. Okay, so number of preference shares to be redeemed are 4,000. Now, you always divide this in two parts. You always divide this in two parts in all the questions. In first part, you take premium on redemption of preference shares, and in second part, you take face value. Why do you take the premium first? Because in premium, we can use security premium account as well as P&L account. First priority, we will use security premium account to write off the premium on redemption. Now see the condition number 1. Preference shares are to be redeemed at a premium of 20%. What is the face value of preference shares? 100. Face value is 100. So 20% premium will be 20 rupees. Face value is 100. So 20% premium will be 20 rupees into 4,000 preference shares. Okay, 4,000 shares are to be redeemed. Total premium what we have to pay on redemption is rupees 80,000. Now, this 80,000 of premium what you pay, how will you write it off? Here we have to apply condition 4. What condition 4 we studied of section 55? Premium on redemption of preference shares shall be written off or provided from first priority security premium account. How much is security premium account in the question? 10,000. So out of this 80,000, security premium used existing will be 10,000. Now, see this third adjustment. 10,000 equity shares are going to be issued at par. So are we going to get any other premium in future or in this issue of shares which can be used for writing of premium? No. You must consider this. Suppose it was given 10,000 equity shares of 10 each are issued at 1 rupee premium. Then further 10,000 into 1, 10,000 more would have been available in security premium account to write it off. But here the equity shares are issued at par. So no other premium is available for writing of this premium on redemption. So remaining amount we will take from profit and loss account. Okay, condition 4 I am talking about. Premium on redemption of preference shares can be written off from first priority security premium. We have 10,000 in security premium, so we'll use that. And then balance amount we don't have. So remaining 70,000 we will use from or we will provide from profit and loss account. See, profit and loss account is sufficient. How much it is? 5,90,000. From that we will use 70,000 to write off the premium on redemption of preference shares. Okay. Now face value. Rupees 100 into 4,000. 4 lakhs is the preference shares face value. Here you will consider condition 2 and 3. Here you will always consider condition 2 and 3. So as per condition 2, the preference shares can be redeemed out of profits of the company or proceeds of fresh issue of shares. Which one should we use first for whichever item information is given? Here you are already given 10,000 equity shares are issued at par, so we already know what are the proceeds of fresh issue of shares. We are going to get 10,000 into 10, 1 lakh. We will use that first. So remaining amount we can take from profit and loss account. So what are the proceeds of fresh issue of shares already given to us? Proceeds of fresh issue of equity shares. Okay, just now we discussed in the previous question that in this proceeds of fresh issue of shares, we will always take face value even if they are issued at premium, because premium is used in writing of premium separately. So here 10,000 shares of 10 each are issued at par, means 10,000 into 10. 1 lakh out of 4 lakhs, 1 lakh. 4 lakhs out of that 1 lakh we will be getting from proceeds of fresh issue of shares. Remaining amount we will take from the profits. Okay, profits means profit and loss account. and we will transfer that to capital redemption reserve. Remaining amount we'll take from the profits and transfer it to capital redemption reserve. How much? 4 lakhs minus 1 lakh. 3 lakhs we will take from the profits of the business and we will transfer this profit and loss account to capital redemption reserve. So what will happen? 4 lakhs of preference share capital will decrease at one end. 1 lakh of equity share capital will increase out of that. And 3 lakhs we will transfer to CRR. So whenever we issue the bonus shares, that 3 lakhs will also get converted into share capital and total 4 lakhs will remain intact. Okay. This capital redemption reserve you consider like a frozen reserve. Frozen reserve means you can use it only for one purpose, that is bonus shares. So capital redemption reserve is as good as share capital only. Okay, capital redemption reserve is as good as share capital only because sooner or later it is going to get converted into equity shares. Now all of you make the format for journal entries in the books of the company. Okay, pause the video and make this format of journal entries. I hope you all would have done with the formats. Now we have to pass the journal entries in the order only. 6 entries I have made you write. Those 6 entries will come in the order only and this workings will come in the beginning of every question. With this workings also you'll become completely confident once we solve 2-3 questions. Okay. So those 6 entries will always be in the same order. First entry what I made you write was for sale of assets. Here you all can see from adjustment 2 we get investments are sold at a loss of 5%. So 4 lakhs of investments, 5% loss, 20,000 they are sold for 3 lakh 80,000. So first entry will be for sale of investments. All of you write down. Bank is the receiver, debit the receiver, bank account debit an amount 3 lakh 80,000. 5% loss means investments are sold for 3 lakh 80,000. Then profit and loss account debit. Now 5% loss as we discussed 4 lakhs, 5% would be equal to 20,000. So profit and loss account debit with the loss of 20,000. And investment goes out, credit what goes out. So to investments account, total amount 4 lakhs. Okay. First entry as we discussed is going to remain same. There is a loss so it will get debited. Bank account debit 3 lakh 80,000, profit and loss account debit 20,000, to investments account 4 lakhs. Being investments sold at loss. Now second entry what we studied, okay, second entry what we studied was for issue of equity shares. Here you all can see in adjustment number 3, 10,000 equity shares are issued at par. So 2 entries will come for issue of equity shares. We studied 2 entries. First, bank account debit, okay, bank account debit to equity share application account, bank account debit to equity share application account. 10,000 shares are issued, so 10,000 into 10 rupees of face value, the amount will come to 1 lakh. Okay, 10,000 equity shares are issued, so 1 lakh. Being application money received. Being application money received. Now, next entry related to the same, equity share application account debit. Since they are issued at par, equity share application account debit 1 lakh, entire 1 lakh will be transferred to share capital. So equity share application account debit 1 lakh to equity share capital account 1 lakh. Being application money transferred to share capital. Okay, so these 2 entries, second and third entry, are for issue of shares. Okay, total 6 entries I have made you write. First entry, sale of assets, that we have done. Second and third entry, in fact second entry itself included that second and third entry, that was issue of shares. Now third entry what I made you write in the notebook was for redemption of preference shares. Directly you get it from here. Preference share capital of 4 lakhs we will reverse and debit. Premium on redemption of preference shares 80,000 we will reverse and debit. and this total amount 4,80,000 we have to pay to preference shareholders, payable to preference shareholders will credit to preference shareholders account. Always will directly get from this workings. Preference share capital account debit this 4 lakh rupees. Premium on redemption account debit this 80,000 rupees. To preference shareholders account we have to pay 4,80,000. So write down everyone. Which preference share capital percentage etc. is not mentioned. So straight away preference share capital account debit. The logic, preference share capital as credit balance. So to close it we reverse and debit it. Okay. Preference share capital account debit 4 lakhs. Then premium on redemption account debit 20,000. Sorry, 80,000. Premium on redemption account debit 80,000 to preference shareholders account 4,80,000. Okay. Preference share capital is a credit balance. To close it we reverse and debit it. Premium on redemption is a capital loss, debit all expenses and losses, so we debit it. An amount is payable to preference shareholders, credit the payables, so to preference shareholders account 4,80,000. Being 4,000 preference shares of rupees 100 each being 4,000 preference shares of rupees 100 each to be redeemed at 20% premium. Then this is the third entry in the notebook which I made you write, because second entry includes two entries, second and third over here. Now fourth entry what I made you write in the notebook was relating to the last condition, writing off of premium. Here preference share capital premium. How much is premium on redemption to be written off? 80,000. Okay, and we have studied here just now. How will you write off this 80,000? 10,000 from security premium and 70,000 from profit and loss account. So this will give you entry number 5. Security premium account debit with 10,000. Okay, out of 80,000, 10,000 we will use from security premium. Then profit and loss account debit with 70,000 and to premium on redemption account with 80,000. So 80,000 of premium on redemption will be written off, would be our next entry, being premium on redemption of preference shares written off. Now sixth entry what we studied was related to transfer of profits to capital redemption reserve. Before we make any payment to preference shareholders, we have to transfer the profits to capital redemption reserve. See here, profit and loss account of 3 lakhs we have to transfer to capital redemption reserve, and capital redemption reserve is as good as share capital only. So all of you write down profit and loss account debit. Okay, profit and loss account debit with that 3 lakh rupees to capital redemption reserve account 3 lakhs. So from profits we will transfer 3 lakhs to capital redemption reserve. What happens? Preference share capital is decreasing by 4 lakh rupees. On the other hand, equity share capital is increasing by 1 lakh, and capital redemption reserve will get converted into equity share capital in future when we give bonus shares. So we can say one more equity share capital is increasing by 3 lakhs. 4 lakhs of preference share capital decreases. 1 lakh plus 3 lakh, 4 lakhs of equity share capital increases. Total share capital remains intact and the interest of creditors and debenture holders get protected. This is the logic behind the conditions of section 55. So being profits transferred to capital redemption reserve. Being profits transferred to capital redemption reserve. And last entry for the payment. Okay, we have to make the payment to preference shareholders. See here entry number 4. What payment we have to make to preference shareholders? 4,80,000. So preference shareholders are the receiver, debit the receiver, preference shareholders account debit with 4,80,000 to bank account. Okay, bank is the giver, credit the giver to bank account 4,80,000. Being payment made to preference shareholders. So this is how we have to solve the question. 6 entries will come. 7 entries are visible because in your notebook in entry number 2 I made you write 2 entries. Okay. The order of entries will also remain exactly same. Now final total is to be done. So all of you do in calculator. 4 lakhs plus 1 lakh, 5 lakh plus 1 lakh, 6 lakh plus 4 lakh 80, 10 lakh 80 plus 80, 1160 plus 3, 1460 plus 480, 1860, 19 lakh 40,000 must be the total of jug. Okay, verified everyone. Even if it's not correct, you can do it on your own and verify that. So this is how we have to solve all the questions. With practice you'll get confident with that. One more question, question number 13 I am going to solve, which is similar to this one, and I would like that I discuss the question and this workings all of you can try on your own, so that you come to know whether you are really clear with the things or not. Okay, so take out question number 13 everyone, be attentive. Yes, question 13. The financial position of, with the correction, of Strawberry Limited on the date of redemption of preference shares is as follows. Share capital, equity share capital rupees 10 each, 40 lakhs. Face value of equity shares is 10. 10% cumulative preference shares capital, 100 each. Again 75 paid up means they are partly paid up. Okay, 75 paid up means they are partly paid up. First of all, they are cumulative preference shares, they are not redeemable. Secondly, they are partly paid up, so they cannot be redeemed. Condition 1 of section 55, partly paid up shares cannot be redeemed. Okay, 10%. Now these are redeemable, these are not cumulative. Preference shares of 100 each, fully paid up. These are fully paid up preference shares, so they can be redeemed. Okay, these only can be redeemed as they are fully paid up. Reserves and surplus. Capital redemption reserve cannot be used. Capital redemption reserve cannot be used neither for redemption of preference shares nor for writing off the premium on redemption. Security premium account can be used to write off the premium on redemption, and profit and loss account can be used for both. Both means what? It can be used for redemption towards the face value also, and it can be used for writing off premium also. Current liabilities, non-current assets, investments, current assets, other information is given as usual. To redeem preference shares, following resolution is passed. First, preference shares are to be redeemed. Cancel this 3. They are to be redeemed at a premium of 10%. Then investment is to be sold at a profit of 10%. Previous question it was sold at a loss. Now here investments are 20 lakhs. So 10% profit will be 2 lakhs. 20 lakhs, 10% profit will be 2 lakhs. Means you can say that they are sold for 22 lakhs. Profit will get added. So they are sold for 22 lakhs. Okay. What will be the entry for sale of investments? Bank account debit 22 lakhs. Bank is the receiver, debit the receiver. Asset investment goes out, credit what goes out to investment account 20 lakhs. And credit all incomes and gains. So to profit and loss account you'll credit with rupees 2 lakhs. 40,000 equity shares of 10 each are to be issued at par for the purpose of redemption of preference. So again in this workings, first we will use proceeds of fresh issue and balance amount we will take from profit and loss account. Okay, first we will use proceeds of fresh issue of equity shares and balance amount we will take from profits and transfer to capital redemption reserve. Now this is a new point over here. The company also issued bonus shares in the ratio of 1 equity share for every 11 shares held, means 1 is to 11. Premium on redemption is required to be written off by using security premium account. Condition 4. Premium on redemption can be written off from priority number 1 security premium, priority number 2 P&L account. But here they say premium on redemption is to be written off only from security premium account, means P&L account is not to be used for the same. Also, this company issues bonus shares of 1 is to 11 ratio. So you all can see that already there are equity shares of 40 lakhs. Against that, the company will be issuing the bonus shares in the ratio of 1 for every 11 shares held, plus 40,000 equity shares will also be issued in the market. So 40 lakhs plus 40,000 into 10, 4 lakhs. 44 lakhs would be the share capital. There we will issue the bonus shares in the ratio of 1 is to 11. So that extra entries will come at the end. First 6 entries, rather 7 entries normal. 7 entries because in second entry there are 2 entries. After those 7 entries, 2 extra entries at the end. Okay, 2 extra entries at the end will come for issue of bonus shares, what we studied in unit 1. Reserves account debit, here particularly we will use capital redemption reserve. So capital redemption reserve account debit to bonus to shareholders, and bonus to shareholders account debit to equity share capital account. These 2 extra entries will come at the end. Remaining everything is exactly same like previous question. So all of you, first of all, pause the video and try these workings on your own. And then I am doing it obviously in detail, but all of you should try these workings on your own, and then you verify from the video whether you are able to get it correct or not. Okay, so pause the video and try these workings on your own, everyone. I hope all of you would have tried the workings now, verified whether you got it correct or not. We name it as working note number 1. Okay, number of preference shares to be redeemed. Number of preference shares to be redeemed is equal to, you all can see here, 8 lakhs divided by 100. 8 lakhs divided by 100 means 8,000 preference shares are there. Okay, so 8,000 preference shares are to be redeemed. Now you divide this in 2 parts. First, premium, and second, face value. Now face value we can see here is 100 rupees, and adjustment 1, they are to be redeemed at a premium of 10%. So 100's 10% premium will be 10 rupees. Now multiplied by 8,000 preference shares are to be redeemed. So 10 into 8,000, same like previous question. Again the premium is 80,000, and 100 into 8,000, the face value is 8 lakhs. Now this premium we have to write off as per condition 4. What I made you write in the notebook. This premium we have to write off as per condition 4. And what is that condition 4? You can write off the premium from priority number 1 security premium account and priority number 2 P&L account. But in this question, in the last sentence, it is already mentioned that security premium account only should be used. See here, premium on redemption is required to be written off only by using security premium account. See in the balance sheet, what is security premium account? 2 lakhs. It is sufficient. We have to write off only 80,000. So entire 80,000 can be easily written off from that amount of 2 lakhs. Now, this face value of rupees 8 lakhs. Okay. This face value of rupees 8 lakhs. How will we utilize it? Here we will apply condition 2 and 3. Okay. Here we are going to apply condition 2 and 3 towards the face value. As per condition 2, you can redeem the preference shares from 2 sources out of the profits of the company otherwise available for distribution of dividend, and second out of proceeds of fresh issue of shares. Since in this question already it is given 40,000 equity shares of 10 each are issued at par, First, we will use proceeds of fresh issue of equity shares. Okay, first we will use proceeds of fresh issue of equity shares. 40,000 shares of 10 each are issued at par. So 40,000 into 10. 4 lakhs out of 8 lakhs can be used from proceeds of fresh issue of shares. Remaining amount we have to take from profit and loss account, profits of the company, source number 1, and transfer it to capital redemption reserve. So 8 lakhs minus 4 lakhs, remaining 4 lakhs we will take from the profits of the company and transfer to capital redemption reserve. So what will happen? Preference share capital will decrease by 8 lakhs. When you issue equity shares of 4 lakhs, it increases by 4 lakhs. And when you transfer 4 lakhs to capital redemption reserve, from that when we give bonus shares, again the share capital increases to 4 lakhs. So total capital remains intact. Okay. Now in this question, bonus shares information is also given. So let us make the working for bonus shares also. Okay. What are the number of equity shares, existing number of equity shares? This workings we used to make in unit 1, issue of bonus shares. Existing number of shares, 40 lakhs divided by 10, you can say 4 lakh equity shares are there. Okay, existing number of equity shares are 4 lakhs. Plus, we have further issued 40,000 shares, proceeds of this fresh issue. So after the issue of 40,000 equity shares, you can say 4 lakh 40,000 equity shares will be there in the balance sheet of the company. Ratio of bonus is 1:11. So what will be the bonus shares quantity? Bonus shares quantity will be equal to 4 lakh 40,000 into 1 by 11. 40,000. 40,000 shares will be given in bonus which are of 10 rupees. So 4 lakhs. 40,000 shares will be given in bonus which are of 10 rupees. So 4 lakh rupees of bonus issue is to be made. Now how will we use this 4 lakhs? We already have capital redemption reserve of 12 lakhs. Plus we are transferring this 4 lakhs also to capital redemption reserve. So this 4 lakhs which we have transferred to capital redemption reserve will be used in giving the bonus shares. Okay. So 2 extra entries will come at the end for issue of bonus shares. All of you pause the video and make the format for the journal entries. Okay. All of you pause the video and make the format for journal entries. I hope all of you would have done the formats. Now first entry we will pass for sale of assets. You all can see here investments are sold. 20 lakhs of investments are sold at profit of 10%. So 22 lakhs is the selling price. So first entry we will pass for sale of assets. All of you write down bank is the receiver, debit the receiver. So bank account debit and 22 lakhs is the selling price. And then investment goes out, credit what goes out. So investments account, investments of 20 lakhs face value goes out, rather book value goes out. And then we earn profit of 2 lakhs, 10%. So credit all incomes and gains to profit and loss account with 2 lakh rupees, being investments sold at profit. Now second entry we will pass for issue of shares in the public. 2 entries will come for that. 40,000 equity shares of 10 each are issued at par. So 2 entries will come for that as we did in previous question also. Bank is the receiver, debit the receiver, bank account debit. 40,000 into 10, 4 lakhs. Okay. 40,000 shares of 10 rupees are issued at par. So 4 lakhs. Now temporarily we will transfer the money to equity share application account 4 lakhs, being 40,000. Okay, application money received, being application money received. Then third entry will be for transferring equity share application to equity share capital account. So equity share application account we will reverse and debit with 4 lakhs, and to equity share capital account 4 lakhs, being application money transferred to share capital. Then fourth entry, so 2 entries are done, one for sale of assets and one for issue of shares. Now third entry is for redemption of preference shares. We directly get it from the workings. Preference share capital account debit with 8 lakhs. Premium on redemption account debit with 80,000. To preference shareholders account, what we have to pay is 8,80,000. So all of you write down. Preference share capital account we reverse and debit to close it. It is a credit balance with 8 lakhs. Then premium on redemption is a capital loss. Debit all expenses and losses. So premium on redemption account debit with 80,000. And amount is payable to preference shareholders, credit the payable. So to preference shareholders account with 8,80,000. Okay, being $8,000 preference shares of ₹100 each, being 8,000 preference shares of ₹100 each to be redeemed at 10% premium. Now fifth entry, after redemption of preference shares, we will have to write off the premium. And in this question, entire premium is written off from security premium account only, unlike previous question where we had written off part amount from security premium and part from P&L account. So we pass the entry security premium, P&L to premium on redemption. Here entire 80,000 we have to write off from security premium only. So that entry will come as security premium account debit with 80,000 to premium on redemption account credit with 80,000, being premium on redemption written off. Okay, so this premium on redemption account we will reverse and credit to write it off, and we write it off from security premium. So security premium account debit. Then after writing off the premium, we'll transfer the profits to capital redemption reserve. So what profits we have to transfer to capital redemption reserve? 4 lakh rupees. Because 4 lakh of share capital is already issued and raised. Remaining 4 lakhs we have to transfer from P&L to capital redemption reserve so that total capital remains intact. So sixth entry will be profit and loss account debit with 4 lakh to capital redemption reserve account 4 lakhs, being profits transferred to capital redemption reserve. Now we will make the payment to preference shareholders. So preference shareholders are the receiver, debit the receiver, preference shareholders account debit. Now what amount we have to pay to preference shareholders? You all can see here this preference shareholders, what we have to pay is 8,80,000. Okay, that we will reverse and debit. Preference shareholders are the receiver, debit the receiver, preference shareholders account debit 8,80,000. Bank is the giver, credit the giver to bank account 8,80,000, being payment made to preference shareholders. And 2 extra entries will come in this question for issue of bonus shares. Okay, because it is given in adjustment number 4 that company also issues bonus shares in the ratio of 1:11. That is the purpose. Why do we transfer this P&L to CRR? because capital redemption reserve of this 4 lakhs can be used here, 4 lakhs. Okay, capital redemption reserve of this 4 lakhs can be used to issue the bonus share. So you all can clearly see in this question, by issuing the preference share, capital decreases by 8 lakhs. By issuing the equity shares, it increases by 4 lakhs. And by issuing the bonus shares, further it increases by 4 lakhs. So total capital remains intact. So two more entries will come. Capital redemption reserve account debit. We will use 4 lakhs from that as per working note 2 to bonus to shareholders account. Okay, this we studied in unit 1. The entries for bonus shares, they are going to remain exactly same, and here they will come at the end, because bonus shares can be issued only after you transfer the profits to capital redemption reserve. So these entries will come at the end. Being utilization of reserves to issue bonus shares. Now last entry will be bonus to shareholders account debit 4 lakhs. Bonus to shareholders account debit 4 lakhs to equity share capital account 4 lakhs, being declaration of bonus. Now final total will be, all of you do it in the calculator, 22 lakhs plus 4 lakhs, 26 lakhs plus 4 lakhs, 30 lakhs plus 8 lakh, 38 lakh 80,000 plus 80,000, 39 lakh 60 plus 4, 43 lakh 60 plus 8, 51 60 plus 80, 52 40 plus 8, 60 lakhs 40,000. Okay, 60 lakhs 40,000 must be the total of channel, or whatever it comes. All of you must be able to do it on your own. So this is how we have to solve the questions on redemption of preference shares. Those 6 entries are going to remain constant, fixed in all the question. Plus you can have extra entries like we had here, issue of bonus shares. You can also have extra entries of calling the preference share final call money. Those will come in the beginning. We'll see that in the further questions when we solve. Okay. So see that all of you revise these things properly. At least 4 conditions and journal entries you keep on revising on daily basis. Okay. That'll be all for this lecture. Remaining more practical questions we'll take up in the next lecture. Bye everyone. Take care. See you in the next lecture.